Good morning and welcome to this morning's webinar on who, what, where and when to use a VCT and an EIS. My name is Dominique Butters and I'm the Business Development Manager here at Blackfinch for the South West and South Wales. My guest speaker today is Dr Nic Pillow. He is the star of the show and I'll be interviewing him later in the presentation. But let's get started. So, important information. Well, first of all, please be aware this presentation is for professional financial advisors, so please don't share these slides with clients. If you want to have the slides though, that's absolutely fine. If you want to have any of the slides to show clients, just let us know, because we can just put the usual sort of caveats, risks on there so you can use them with clients, just ask. So, risks. The FCA has given us another set of risks which are in relation to EIS. Now, some of these points are very fair, some are a little bit unfair, such as you could lose all the money you invest. Well, actually, yes, on an EIS, some of these companies could go to zero. However, when you consider how much tax relief some clients can get, how much are they actually risking? Sometimes very, very little. It can be as little as just 2%, and that's without taking into account loss relief. So when we're looking at EIS, yes, they are deemed as high risk, but actually probably the biggest risk and the biggest objection, if you like, is the lack of liquidity. These are not listed shares, these are private companies. And when I go out to see clients with my advisors, one of the first things I say is, okay, this is long-term, proper investment. Even if you die, because we often do it for IHT planning, even if you die, there's no liquidity. Your children, your beneficiaries will need to inherit the shares. They're not going to worry though, because the amount of tax you've saved. So just bear that one in mind. Don't put all your eggs in one basket. Absolutely. You'll see later that we give you a diversified portfolio of at least 10 to 12 different companies. Last year, actually in March, in the last week in March, we invested across 17 different companies. So beautifully diversified portfolio. And you as regulated advisors probably wouldn't be allowed to even promote a single company EIS share anyway. So the learning objectives for today. Well, we're going to understand how to outline VCTs and EIS and how they can actually help with diversification in a client's portfolio, actually ignoring tax relief. So that's going to be quite an interesting thing you've probably not seen before. Identify the typical clients who use VCTs and EISs. The list isn't exhaustive, but it's the most popular ones. And then at the end, you should be able to summarise what's so special about the Blackfinch Spring VCT and EIS portfolios. My first very interesting slide. Can you believe that in the last 20 years, 14 of those years have either seen both positive or both negative returns of S&P 500 and corporate bonds? So when we're looking at a beautiful balanced portfolio using bonds and equities, actually 14 out of the last 20 years, they've behaved in exactly the same way. That was quite shocking to me. Although in 2008, dead handy, you had some corporate bonds in there. We could look at that big drawdown on the equity side. And this is a famous quote: diversification, after all, is not how many different things you own, but how different the things you do own are in the risks they entail. So putting more equities or more bonds into a portfolio, does that provide extra diversification? Or actually, do they actually all act in the same way? So we simulated 50,000 portfolios. You'll be very used to seeing this screen. This is the efficient frontier. Now, take a note of the red marker and the green marker. So of course, up the left-hand side is expected returns. We want to be as far up there as we can, and volatility, so risk, we don't want to be too far over on the risk side for the amount of return. But if I ask you, which marker would you prefer your portfolio to be in, the red or the green? I know which one I would prefer. So let's have a look at the difference. So the difference is on the red marker, that's just a simple balanced portfolio. So we're looking at 55% global equity, 35% bonds, 10% cash. And if you can remember these figures, return of 5.69%, volatility risk 8.67%. Now, the whole reason why we investigated this is because we wanted to try and ascertain if you put in things like venture capital, smaller companies, i.e. AIM, if you put in our IHT portfolios, how much extra risk are you taking with your client's capital? Because to be honest, we didn't have any scientific answers. Well, now we do. And this is independent research that we've done. Your green marker, what we've done there is added in 10% of venture capital into this portfolio, 10% into UK small cap to represent AIM. Still got 10% cash in there, 20% bonds, 40% equities. But we've also now got 10% in other assets, 5% direct lending, 5% infrastructure. And that's there to represent things like our Adapt IHT portfolio. But we haven't skewed the figures here by putting in our actual IHT portfolio, which has pretty much no volatility whatsoever. It's never had a negative return to bring that volatility down. This is all using funds and independent data. But as you'll see, the return has gone up quite dramatically, 6.06% now, but volatility has only gone up a smidgen, and actually well within the balanced risk tolerances. So I've always felt that actually, if you're putting in, because let's face it, we're putting 30% of a client's portfolio now into other assets, you'd perhaps be taking them up the risk scale, so you could perhaps put their portfolio down the risk scale to compensate. But this is actually showing you here, by putting in 30%, no, still within the tolerances of the balanced risk client, but actually has improved performance. That's without the benefit of any of those tax reliefs that you can get from venture capital, smaller companies, and the infrastructure side. So really quite interesting. By the way, this is a very small snapshot of a very big presentation we have, and we have a diversification paper which shows all the research. If you haven't seen it and you're interested, do let your own BDM know. They'll happily come out and have a chat to you and go through it with you. But VCT and EIS tax relief, so this is on top of actually providing better performance for your portfolios as well. So VCT, I always call it my nice, simple, straightforward one. I like it because you get one tax certificate. Delightful. 30% income tax relief. Got to hold it for 5 years to keep that tax relief. So again, I always say, look, if you can't think that you can leave it there for 5 years, don't invest, or invest a smaller amount. You can get out, but you've got to pay back your income tax relief. So basically, don't do it. Tax-free dividends, and a VCT is an income vehicle. It is all about those tax-free dividends. So when there's profits in a VCT, you would expect for those to be paid out as a tax-free dividend. But all growth is also tax-free. Maximum you can put in is £200,000 per person per tax year. EIS, this is the Rolls-Royce of tax planning, because it has almost basically every tax relief you could possibly want. 30% income tax relief. However, unlike a VCT, which is current year only, you can actually carry back income tax to the previous tax year. So you can clear last year's tax bill and this year's tax bill with the one investment. But you have to be holding it for at least 3 years to keep that income tax relief. If a company is sold, and that can happen, the company is sold, they do have to pay back the income tax relief on that one company, not the whole portfolio, but on that one company it's relevant to. EIS is a growth vehicle, so there's no income paid on these. These are growth investments. Any, if you like, dividends they would pay out are actually reinvested into the company to grow them further. So you'll see the return in the way of CGT growth, CGT-free growth, I should say. You also get loss relief, and I've got an example of that later. That's probably one of the most powerful tax reliefs there are with EIS. If you can get your head around that and explain that to clients, to be honest, for most clients, it's a little bit of a no-brainer then doing an EIS. CGT deferral relief, you're only deferring CGT, but you can defer CGT indefinitely and until death, and on death, CGT uplift, CGT dies with the client. So it can be really powerful, especially for your older clients. It's also inheritance tax relievable. So it also qualifies for business relief. So once those shares have been held for 2 years, no IHT. So when that client dies, no IHT as long as they're holding those shares at the time of death. Now, the government really want you to be investing in EIS companies. So you're actually allowed to invest up to £1 million per person per tax year and £2 million per person per tax year for knowledge-intensive ones. So really generous. But who, what, where, and when to use the VCT? Well, probably the most popular use of a VCT is with business owners who have surplus capital in their companies. They take tiny salaries, rest in dividends up to the basic rate tax band. So I'm not taking any more tax, I'm not paying higher rate tax. Well, okay, but money in a company is always at risk. You know, really you should be trying to get it out and into your own pocket. But at higher rate, at what, 33.75%, I can understand them being reticent. But if you could say to them, well, what if we could get the effective tax rate down to 3.75%? Pretty much without exception, they go, oh, we don't mind paying 3.75. It was the 33.75 I wasn't keen on. Great, take a dividend, pop it into the VCT. You're now going to offset 30% of the tax on that dividend. Basically, it's a 5-year exit strategy for getting cash out of the company tax efficiently. And I'm going to show you how later on another slide, how this really, really helps company directors, how they get really excited about it. Landlords, this is an unusual one. A lot of people don't think about landlords because, of course, they don't have net relevant earnings. But of course, the VCT and EIS, you don't have to have net relevant earnings. You can get any old income tax back, earned, pension, savings, rental, even chargeable event income tax if you're selling a bond. All income tax is reclaimable. So landlords, where they're probably scuppered on pensions, why not a VCT? Because what's a pension? It's just an income in retirement. Well, landlords are probably thinking, well, their rental income is their income in retirement, but what if you could make that tax-free? How much tax do they pay? Pop an amount into a VCT, offset the tax. Do that each year for 5 years, and they'll never pay tax on their income ever again. What's not to like? Then they'll be benefiting from tax-free dividends, so tax-free income in retirement as well. Really, really good as an alternative to a pension. High earners, you've done the pension, you've done the ISA, now what? Well, they're paying lots of tax. Why not get some of that tax back for them? Great way of differentiating yourself as well. Clients who are limited on pension contributions, so I can't put much in. Well, again, great alternative. Retired clients, this is another one that surprises a lot of people. But retired clients, they're always risk averse. Well, you've just seen that you can put quite a substantial amount into other assets. Because they're working in different ways, they provide real diversification and therefore doesn't increase the risk as much as you think it's going to. Also, retired clients, they don't pay much tax normally. So actually, you're only putting in a very small part of their overall portfolio. You're making them potentially non-tax payers because we can do one each year for the next 5 years. I'm stealing my thunder here. And they're getting those tax-free dividends as well. Again, really appealing. And one that isn't on here, when I speak to my advisors and say, why do you do lots of VCTs? Because a lot of my advisors don't do that many. They say they do it for their best clients. I said, what do you mean your best clients? It's the ones we'd cry if they left us and took all their ongoing fees. Now, happily, they tend to be the retired clients. They've got £1 million over here that the advisor's getting fees on. They don't pay much tax, but ask any retired client, how do you feel about paying tax in retirement? Sit back, have your cup of tea, because they'll rant for at least 10 minutes on how unfair it is. I paid tax all my life. Now I'm still paying tax. Brilliant. Well, as part of a review then, we're going to look to get all your tax back. They're flabbergasted. They think it's amazing. It's 10, 20,000, 30,000 a year that they need to invest. But now they're going to be non-taxpayers. What most of the, not all, but most advisors do is actually give that advice for free as well. Now, they'll still take the 0.5% ongoing that's built into our VCT, but they tend to do it for no fees. The reason why is they're already getting a good chunk of fees over here on the main portfolio. And it's been very handy in the last couple of years where clients have been quite grumpy that perhaps their portfolios are falling or not making much money. Oh, well, you're still taking your fees, aren't you? You're the only person making any money. Well, actually, if you've already said, and we're going to, as part of your overall diversified portfolio for free, make you a non-taxpayer, well, they can't really have a go at justifying your fees when you've just said you're going to give something for nothing. I thought that was really genius, to be honest. So building their funds under management, building their ongoing, but giving them a little freebie at the same time. And everybody loves getting something for nothing. So why invest in a VCT? Well, we've said about the tax reliefs, but also it's very complementary of other investments, probably something completely different to anything else they'll have in their portfolio, because you are accessing alternative asset classes. Diversifying tax wrappers, you're adding in another one here. And of course, you are supporting small growing companies and the UK economy. And actually, a lot of wealthy clients really like the thought of doing that. This is where I stole my thunder earlier. This is my favourite slide. This is where you invest in a VCT, 1 year, 2 year, 3 years, 4 years, 5 years. The biggest advantage of a VCT is you can sell those shares back to the VCT at the end of the 5 years. So at the end of 5 years, you take out the first investment, reinvest it in another VCT. It does have to be different VCT, or you have to wait 6 months. But you're going to get another 30% tax relief on the same money. Year 2 does year 7, year 3, and so on and so forth. So you've got this fantastic conveyor belt where you're getting 30% tax relief on the same money every 5 years. And this is where you can make people like landlords, potentially high earners. You can make your retired clients, your best clients, non-taxpayers, actually quite simply. But why our VCT? A couple of things I'm going to point out here. We are going to be paying out dividends next year. We reconfirmed our commitment to paying out our 5% regular dividends from next year. Our charges are incredibly good. We don't take a performance fee until we've hit 130. Current now is about 97p, so a long way before we're going to take our 20% performance fee. But one of the biggest advantages at the moment is that valuations are massively depressed. And the reason they're depressed, we invest in tech-enabled companies. Now, because a VCT is a PLC listed in the main stock market, we have to take into account the valuations in the main market when we're dealing with our unlisted companies. Bizarre, I know. But tech companies used to be valued around 15 times, currently valued at 5 times. So we're having to downgrade the valuations on our little companies to actually reflect that. And yet the companies are doing so well, they've actually outperformed that, and the NAV's gone up by 3p. So just to be a little bit show-offy here, actually, the Wealth Club did some research, and this was published in IFA magazine a couple of weeks ago, and they compared 38 different VCTs. And as you'll notice, Blackfinch Spring VCT has the highest number. 85% of the companies in our VCT are on high growth. What does high growth mean? They've grown their revenues by over 25% in the last year. And in fact, half of those have grown it by more than 50%. So I've been saying for years that we've got a brilliant VCT and it's going to be fabulous. Now I've got independent research, which actually shows that too. And then on top of that, depressed valuations. Wow. But what about EIS? Who, what, where, and when to use an EIS? To be quite honest, a lot of the clients are exactly the same as a VCT, but perhaps they now have an IHT liability as well. So it might be worth doing an EIS to get that 40% saving. Or the most popular reason why people do an EIS, I always say it's to get you out of something you don't want anymore. Share portfolio, bond, a buy-to-let, holiday home. But actually don't want to sell it because they don't want to pay capital gains tax. Sell it, give rise to the gain, because the beauty of an EIS, it's only the gain, when we're deferring capital gains, only the gain we're having to put in, which will defer the tax liability. If you have clients in that situation, do speak to your BDM. We'll be very happy to go through it in detail, hold your hand all the way through it. If you're not familiar with it, we've got case studies, everything on it. But basically, that's the one. CGT deferral, ultimate mitigation of that CGT becomes really, really powerful. And this is where you can potentially get up to 98% tax relief with an EIS, where we can defer and ultimately get rid of capital gains tax, as well as having 30% income tax relief, as well as potentially saving that 40% IHT as well. But EISs are more complicated, but that's why I'll never be out of a job. They are more complicated. So I always say with an EIS, you want to be benefiting from at least 2 different tax breaks to make it worthwhile. If you're only going to really be benefiting from income tax relief, a VCT is probably going to be a much easier option for both you and the client. So why invest in the EIS? Well, I've told you about the tax breaks. We will invest you this same tax year. We will do it across a minimum of 10 to 12 different companies to provide diversification. And again, access to that alternative asset class. Loss relief. This is probably my most favorite slide. I see clients and they say, oh, but Dominique, you just told me there's a really high risk investments. What if I lose all of my capital? Well, not being rude to our fund managers, but surely in a portfolio of 10 or 12, they could pick one winner. Surely a 3-year-old could pick one winner. Because actually, we're looking for every company to grow at least tenfold in our time period, 4 to 7 years, or we won't bother investing. Well, if you've got a portfolio of 10, you only need one company to do that, and you've had all your money back, 30% income tax, loss relief at your highest marginal rate. So let's look at this. Let's assume they're all a disaster. You've invested £10,000. Well, HMRC says, well, how much have we actually lost? Well, hold on, we gave you 3,000 in income tax relief. So you haven't lost that, but you have lost the 7,000. You can now offset that against income tax in the previous tax year or the current year, or offset it against capital gains in that year, or any deferred gains, or any future capital gains. Well, if we've got a 40% income taxpayer, they're going to get a further £2,800 in tax relief. So they've had 3,000 to start with, 2,800 in loss relief. That's £5,800 out of the 10 they invested. And that's not taking into account any CGT we might have saved, any IHT. So the maximum they could lose is 42% of their capital. But the maximum upside is unlimited and tax-free. So our VCT, what are we looking for? Well, we're looking for a return on average across the portfolio of 3 times capital. Because we're hoping a couple will fly, some will do okay, and some will fail. And that's what we expect, around about a 3 times return. Our fees are incredibly good value. The couple I want to point out here, we take a 2% AMC, but only for the first 4 years, and the client doesn't pay it, the investee company does. So we're massively incentivized to get early exits with maximum value, because really our main profit comes in our performance fee, but we only take 20% once the client has made 30% return. So there's no big bill being built up on a 2% plus VAT with other people, AMC building up over the next 10 years that comes out of any return. And the 20%, we're only taking it after 30%, whereas most of our competitors will take 20% when they've made you £1. Rude. So, but this is the star of the show. I now want to introduce you to Dr. Nic Pillow, one of the lead fund managers on our ventures team. You can read his CV here, but what I love about his CV, the sort of sixth most impressive bit about Nick, is that he's got a PhD in AI-powered computer vision from Oxford University. Now, this is in the days when I don't think any of us would have even heard of AI, never mind computer vision. So one of the pioneers here. And I'm actually going to ask Nick some questions on your behalf that, to be honest, people always ask me. So Nick, thank you for joining us today. Can we start by just explaining yours and the team's backgrounds to give an idea to advisors, if you like, your experience in this area?
Thanks, Dom. Yes, one of the key features really of the Blackfinch team is that many of us do have backgrounds as founders and having run startup businesses. So in my case, as Dom's pointed out, I have the background on the academic side with a PhD in AI. Not that that would be too useful these days, but I've then been part of a number of startup and scale-up businesses over the intervening years, and the big companies that have bought them out, because the companies I've been part of have then been acquired by large organizations, which is a typical exit path. And in fact, immediately before joining Blackfinch, I'd founded and run my own startup. So I've seen that from the point of view of a founder. Similarly, Dr. Ruben Wilcock, another PhD on the team, he runs the team. He has founded about 4 or 5 tech startup businesses, as well as having written a large number of academic papers and really got to understand the technology, but in his case very much the commercial application of technology. And in fact, in his case, he also ran a startup accelerator, which is where you get lots of companies, startup companies together, and you get training and coaching in all different aspects of making a success of your business, including pitching to investors. And you can imagine that type of experience that we've all had, but he's particularly got absolutely invaluable when we're on the other side of the table working out which companies we do actually want to back, and maybe ones which are just sort of sounding good but maybe don't have the substance behind them.
Brilliant. Well, actually, on that, how do you go about finding all the investment opportunities and which companies to invest into?
Yes, we actually look at over 1,000 companies a year between us. We work very much as a team, and we've got various ways of going out and trying to find companies. People do come to us. We've been running now for the best part of 5 years, and so our name is out there, and people do send things in. But we tend to get higher quality leads from our various networks with accelerators, with other investors, with people we know. And, we've all been doing this, as I say, in our previous lives. So we're well connected with lots of other founders. And then something that's a little bit different, we actually go out looking for them. We've got a research tool that lists lots of information about every company in the UK. And we do focus on UK companies, obviously, because of the EIS and VCT schemes. And we've got some sort of quite well designed searches that will let us pick out companies that we think are at about the right sort of stage, doing the right sort of thing, that might be interested in investment. And we approach them. And obviously, quite a few of them, it's not applicable. Other ones, very interesting opportunities that we just wouldn't have found otherwise. And sometimes we get then almost exclusive rights to, because they've got an investor talking to them. They don't need to go out and look for competing investors.
True, brilliant. What are some of the more subtle things you look for? Because you're obviously seeing all of these companies, and there's probably going to be a large list which are really good companies. So how do you really nail it down? Those companies you think, yeah, they're really special.
Yeah, it's a good question. There's no silver bullet in what's going to be an amazing company. It's about looking at lots of different aspects of the business and picking up all the signals about them. And we've got a multi-stage process. We try and keep it as objective as possible, because we want to have looked at as many opportunities as we can, and we don't want to throw things out just because someone hasn't had a warm introduction from someone we know or whatever. We will look at everything. But it's then, okay, let's establish the basics, but then let's go into the detail as well. So I mentioned a moment ago Ruben's experience coaching founders to pitch to investors. And what normally happens is that a founder will pitch to investor for about an hour. That's typically what happens. And founders therefore get very good at presenting this wonderful, glossy story, all the good bits of their business. And it takes about an hour. And so we deliberately make our pitch sessions, when we get that far, take at least 3 hours, so we can really pull apart what's going on. And we don't expect every company to be perfect. These are startups. By definition, they are a work in progress. We don't expect founders to have all the answers instantly. But what is quite telling, for example, is how they respond when they don't know something. Are they just trying to, to put it sort of reasonably politely, blather their way through, or are they, actually saying, "Oh, actually, I don't know. Let's think about that and try and work something out." And then you can see sort of the cogs turning, and they're listening to what we're saying and the input we're giving, and you say, "Okay, so this person is prepared to take input, to be coachable, and it would be someone who could actually engage with the hundreds and thousands of problems they're going to have on their journey as a founder, and take our input." I mean, not do what we say, but at least listen to what we are saying. And so that's the sort of the pitch stage. And I could talk about this all day, but let me just give you one other example. When we get further on in the process, when we've said, yes, this is a company we really like, but we're doing our more detailed due diligence, we will, for example, have reference calls with customers. We pick the customers at random. We don't go to the company and say, "Oh, give us a list of 3 companies we can talk to." They will obviously give us their friendly ones. We get their full list. We pick however many at random, and say, right, I want to talk to this one, this one, this one. And you have the calls. And you have to be careful with this, because even when we've picked the companies had to introduce them to us. No one likes to say bad things, about someone. So you have to listen to what they don't say. And again, you don't expect a company, a customer to be saying, "Oh, this is, absolutely perfect, a product in every respect." Again, you expect it at the early stages to be a bit rough around the edges. You want them, yes, of course, to be delivering some clear business value, but is it? But okay, it'd be good if they did this. They could do that. Oh, we had a bit of a problem with this. That's all fine. What's important, though, is that they always are really enthusiastic about the responsiveness and the support from the company, because the one advantage an early stage company has is its agility and the small number of customers. And if they can't look after those well and actually respond to what they want and provide brilliant customer service, then it's going to go, it's very likely to go badly wrong as things expand and they get more and more customers in there. So they've got to be enthusiastic about that. If they don't mention, it's like, okay, the product might be good, but there's something going wrong here.
Yeah, brilliant. Well, once we have invested, how do we try and add value to these companies?
Oh, yes. 2 parts to that, really. Obviously, as I've mentioned, a lot of us on the team have our own experience as founders and running these startups, and we, collectively in the team, take board observer rights on these companies, which means we get to participate in all the board meetings, but also talk to the founders at other times, and we collect information. And sometimes the companies quite like the fact that we say, no, you've got to give us this data, not just financial metrics, but like business, KPIs, key performance indicators, because it helps them run their business as well. But we pool all this information, and within the ventures team, we talk about every company every month, and trying to pick up any little problems, trying to see where we can help just from our own experience. So that's one side of it. The other is, in addition, for nearly all companies, we are able to appoint a director to their board. So we take observer rights, but we actually appoint someone else as a director, and someone that we think is going to add real value to that company. And sometimes that's for their business experience. So, for example, we've got one lady we've put on a couple of boards, brilliant at marketing. She's run her own business, taken it to the States, sold out, done very well. But her thing is marketing, and the companies that need that extra, support, they don't know where to start with marketing. How do you hire someone to run a marketing team when you don't know anything about it? So, she'll get that set up and then spend a lot of time, more than we pay her for, to be fair, actually working with the company, to get that running. In other cases, it's dedicated sector specific experience. So I should start giving some examples of companies, really, and one in our portfolio, a company called Transreport, and they have a solution for people with limited mobility to book and then receive assistance on public transport journeys, especially on trains. So it's all started with trains, and Transreport runs the system that every train operating company in the UK uses to book and provide assistance, for example, a ramp to get a wheelchair on and off a train. And you need to know if you need a ramp, the ramp is going to be there when you want to get off your train, even if it comes into the wrong platform in reverse formation 30 minutes late. Otherwise, you're stuck on the train till it gets to the depot, and that's not good for anyone. They've got this wonderful system. When we invested, we said, right, the person who's going to add value here is someone who really understands the train industry. And we managed to find one of the founders of the Trainline app, and they'd sold out, lots of experience, lots of contacts. Within a month of our investment, of appointing this director, he had introduced them to the Japanese, and they are now rolling out their system on Japanese railways as well. So that's the type of value that we can provide.
And that is amazing, because these companies are brilliant, aren't they? But seriously, how long would it have taken that company to know Kevin in Japan, to get in there? It's amazing, isn't it, how they can add that value and just make them grow that much quicker. Fabulous. Yeah. But there's always the downside. There's not going to be all successes. Wouldn't that be wonderful? Can you tell us about perhaps a failure we've had and why?
Yes, failures are always really interesting, and we try to learn from our failures as well. So to give one example, there's a company called Oro. They had a wonderful vision to provide a virtual personal trainer. And we invested at quite an early stage. We always like to have a range, some earlier stage, some later stage. This was an earlier stage one. And they'd already done experiments with being able to talk to the app, so that you could say, oh, I want something a bit harder. But basically, at this point, what they were offering was audio training, which seems sort of pretty obvious these days, but this was going back to 2019, before COVID. So they had these audio workouts, and audio made a lot of sense, because if you're running, you're in the gym, you can't necessarily look at a screen and see what you're supposed to be doing. Video doesn't work so well. And this was starting to grow really well, and they had some amazing channels to market. That was their superpower, all the deals they were doing to be able to get customers. It was fantastic. COVID comes along, we think, brilliant. Everyone's going to need this now because they can't go to the gym. Um, um, and it was for a while, and it shot up. And then suddenly, Apple came into the market, released Apple Fitness. Plus, you've got the Joe Wicks phenomenon, all this sort of thing, and all the other, contenders just fell by the wayside. And we couldn't put the resources in to compete with Apple. I mean, very, very few investors would have been able to do that, and it hadn't been able to get to the point where it has sort of realized its virtual personal trainer vision. And so regrettably, it failed. And we don't believe in putting money into companies, for the sake of it, just to keep them alive. There's loss relief there on the EIS side. That's how it should work, because every money, all the money we put into a company is from new clients, and we always believe, it's got to be the right investment. So yeah.
Brilliant. You have that discipline, don't you? You treat every new investment as if it is a brand new investment, even if it's a follow-on. Brilliant. But now, one thing that my advisors always ask me for are, what about the successes? What are the we haven't got much time, but maybe a couple of companies that are doing really, really well that they might be investing in an EIS or the VCT that they can share with clients to really bring it to life. So I don't want any really, really techie ones that only someone with a doctorate in AI is going to understand, because some of these they straight over my head. But something that tangible that people can go, oh yeah, my clients are going to get that.
Yeah. Okay, how many have you got clients with children who are at school, maybe doing A levels or even GCSEs? Hopefully that's one people can understand. And we've got a company called Uplearn, very simple name, and it is a platform to teach at the moment certain subjects like maths, at A level, and they're just introducing GCSEs as well. And 97% of people who complete the course on Uplearn go on to get an A or an A star. And that's not just because it's the ones who are going to do well anyway. People who start with predicted Ds or Us, they still go on to get the A or A star. And the company actually has a money back guarantee. If you don't get an A or an A star and you've completed it, then they will give you your money back. And it's a handful of people who ever get their money back. It is that good. It's all based on really good ways of learning. So definitely look up that one. And if I've just got time, another example, Tended, which has had it was an earlier investment we made, actually again back in 2019. It's been on quite a journey, and perhaps another time I can tell you the journey it's been on through COVID, when all its contracts got cancelled. It came out with a social distancing device that was brilliant, used by Rolls-Royce and BBC and people, but then lockdown stopped. No one needed to social distance anymore. What has it done? It's got now a product which is for geofencing. Now that sounds a bit technical, but it's quite simple. Let's take the example on the railways, which is the main one they're working on at the moment. Every year, sadly, workers die on railway lines because they're working on a line that's been closed down, but they stray into the path of a live train on a live line. It's very sad. I think it's like 20 people have died in the last 10 years. And you can't build a fence up because you're doing this spot bit of work on a railway line. What they've got is this virtual fence, and Tended sells this device. It looks a bit like a walkie-talkie, and it's got centimeter level positioning, and it tells so everyone knows exactly where they are. And importantly, the system knows exactly where they are. If they stray by a centimetre outside what's been designated as the safe area, and you'd like to think there's a bit of a buffer there, they will be alerted in no uncertain terms that they are somewhere dangerous, and all those around them will also, be aware. So it's got a light, it's flashing. There's a big alarm that goes off. It's vibrates. What's you're in there. That is doing very, very well at the moment. And yes, it's recently announced a very, very large contract with Siemens. So
I think
that
it's
is
in
going
the public domain, so I think it's something like 7 million over the next 5 years.
up to 7 million
yeah.
for the current scope of work, but who knows?
know.
Yeah, very, very exciting, that one.
They also won Time Magazine's Technology of the Year for that on safety device. So Time Magazine, it just seems so exciting. Our little company here in the UK winning Time Magazine's Tech of the Year in 2023. Fantastic.
With the founder being one of the Forbes 30 under 30.
Just imagine what else he's going to go on and do. I still want to introduce him to my daughter. Anyway, that's a complete side point. Thank you ever so much, Nick, for that today. I'm now going to let you go and share my screen again. And we are then going to finish up, hopefully, with our learning objectives. So what did we say we were going to cover today? Well, we're going to outline how VCTs and EIS can help with diversification of clients' portfolio. So imagine we've increased the performance of your client's portfolio, then you add the tax breaks in again. Incredible. And we said we'd identify the typical clients who use VCTs and EIS. Obviously, we had very limited time here today. Do speak to your BDM. They'll have much more time to go through each type of client and actually go through clients with you in person as well. And then hopefully you've realised what is so special about the Blackfinch Spring VCT. As a reminder, buying at a massive discount at the moment, but we've got the most growth companies and rapid growth companies in our VCT compared with everybody else, but you're buying at that discount. So you're not even buying it at the right price. And the EIS portfolios will get you fully invested this side of the tax year in a beautiful diversified portfolio, so really quick on investment. And, you know, we do a lot of follow-on into our very best companies. So those ones, they're growth companies, they need more funding. So ones we've talked about today, your clients could well be investing in those in their portfolio if you invest with us, as well as some new ones too. So it just leaves me to say thank you so much for joining us today. We really do appreciate your time. If you'd like to have a copy of the slides, then get hold of your BDM. We'd be more than happy to provide those to you. And if you have clients to discuss, again, we're here to help. Thank you and have a lovely weekend.